The Bank of England is expected to lower its key interest rate to 4% from 4.25% this week and potentially again by year-end, despite rising inflation nearing double the target of 2%. Policymakers are split on the easing of underlying price pressures and whether further rate cuts are necessary to avoid medium-term inflation undershoot. The surge in British inflation, higher than in the Eurozone or US, was mainly due to reliance on natural gas post-Ukraine invasion. Although it fell sharply in 2023, it's risen more since and is projected not to meet target until early 2027. Business and household inflation expectations have risen significantly over the past year, impacting future price rises and wage demands, but some officials view these surveys with skepticism. Two components of UK inflation, services price inflation and core CPI, have remained higher than headline inflation, hinting at persistent domestic price pressures. Food and drink inflation has also begun to rise rapidly. Despite slowing, annual private sector wage growth remains significantly higher than pre-pandemic levels, putting downward pressure on inflation. However, the drop in wage growth over the past year has not been consistent. Businesses are reportedly raising prices at a robust pace, with costs for both services and manufacturing rising sharply over the past year, which could lead to increased consumer prices if passed on. In conclusion, policymakers face a challenging decision as they grapple with rising inflation expectations, persistent domestic price pressures, and conflicting views on the easing of underlying price pressures. The slowing labor market and sputtering growth may influence their decision on whether to further cut interest rates to mitigate these pressures in the medium term.